So the 2008 financial crisis, also known as the Great Recession, was primarily caused by large banks becoming financially insolvent. So if I deposited $100 at Chase in 2007, in 2008, there was a good chance the $100 I gave to the bank was gone. Now scale it up to millions of Americans who had thousands or hundreds of thousands of dollars in their savings accounts. All that money would have been wiped out if not for the federal government who stepped in and reimbursed the money that was lost, effectively bailing out the banks. That's why you might hear the term too big to fail and the controversy that surrounds it. So how exactly do the investment banks manage to lose that much of their depositors' money? Fundamentally, it happened because of something called the securitization chain. It starts with the average people, like you and me, who take out mortgages for homes. The bank that I take the loan out from then sells the loan to an investment bank. The investment bank breaks up the loan and packages it with other loans into something called a mortgage-backed security and sells it off to investors. So at the end of the day, when I make my mortgage payments, that money is going to the investor who ended up effectively buying my mortgage. However, there's always a chance I won't pay my mortgage back. Because of that risk, investors might end up buying that mortgage and losing their investment. But the lender I originally took the loan out from already sold the mortgage, so they've already got their principal back. So what the lender is doing by selling your mortgage is effectively handing over the risk to someone else. A simple example would go a little bit like this. I take a $100 loan from the bank that I'm going to pay back in a year at a 10% interest rate. The bank then sells this mortgage to an investment bank for $100. So the lender has already got all its principal back, even though they just made me the loan. So now the investment bank sells the $100 loan for $100 to an investor. So they bought it for $100 from the lender and sold it for $100 to the investor. How the investment bank makes money through this exchange is by charging a 2% fee. So when the investor buys a $100 mortgage from the investment bank, the investor pays $102 and the investment bank keeps the $2 difference, which is their profit. So now when I make my mortgage payments, they go to the investor who stands to make $110, an $8 profit after a year. Now imagine that the investment bank facilitating millions of these transactions where they buy from a lender and sell to an investor. On each transaction, they take a 2% fee. So the investment banks had an incentive to keep selling mortgages, but eventually mortgages ran out. There's only so many creditworthy Americans who are taking out mortgages on homes. So what the banks did was lower the criteria for obtaining a loan. That increases the risk of the loan not being able to get paid back. So fast forward to 2008, the investment banks have bought a ton of these risky loans from lenders, and investors don't want to buy them from the investment banks because they realize the loans aren't going to get paid back. That left the investment banks with billions of these loans that they paid for with depositors' money, which were essentially worthless now. Now, when people finally realized this, all hell broke loose. Everybody was withdrawing from the banks, which had lost most of their depositors' money anyway, so only a small fraction was returned back to depositors. The stock market tanked because people's savings were being wiped out, and that led to further capital losses in the economy. And of course, the banks were eventually bailed out and depositors got their money back. This is by no means a comprehensive explanation, and it gets a little more complicated than this, but hopefully you get the idea. Moving on to the video, the idea that the professor presents is that the crisis was a direct result of two economic theories, externalities and asymmetric information. As far as externalities go, there were probably too many to count in this case, but one that was apparent to me was that if the banks made unprofitable investments, depositors would be the ones to lose their money, since the banks were speculating with depositor money and not their own funds. Another externality was the impact on the borrowers who ended up obtaining these risky mortgages. The banks were supplying risky mortgages to borrowers so that they could then sell them to investors. These borrowers weren't able to pay them back because of high interest rates and often went into debt or lost their homes. Finally, a particularly controversial externality is when the banks were not able to make successful investments At the end of the day, taxpayers ended up paying for their mistakes when the government bailed big banks out using taxpayer dollars. Asymmetric information and adverse selection also played a large role in the crisis. When investment banks were selling these risky mortgages to investors, for a long time, the investors didn't know the mortgages were risky. So when the crash finally occurred, investors suffered a great deal because they just didn't know what type of product they were buying. However, when investors finally did find out these mortgages were risky, they stopped buying them from banks. What this did was all of a sudden left the investment banks with an adverse selection of toxic mortgages that were not going to be paid back and that nobody wanted to buy. After the crisis, there were a lot of public policy decisions that were made to prevent something like this from happening again. The most momentous was the Dodd-Frank Act, which, among other things, placed a limit on how much of depositors' money banks can make investments with or speculate. Another public policy was to reform the rating agencies who determine how risky these investments are. So before the crisis, poor work from the rating agencies left people without an idea of how risky these mortgages were, which led people to pour money into them. With these reforms, they're trying to combat asymmetric information between the investors and the investment banks selling them the mortgages. I gained interesting insight from the documentary Inside Job. It revealed that the investment banks selling these mortgages to investors knew that the mortgages were bad. I don't know, I don't want to get into the weeds too much, but they can confirm this because what the banks did was they bet against the very mortgages they were selling to investors. So they'd sell a mortgage to an investor, bet against that same investment that they just sold to the investor and marketed as a good investment, and then they'd make money when the investment went bad. I thought this sort of connected back to the whole idea of asymmetric information and how the seller can know more about the product than the buyer, which causes inefficiencies in the market. So basically, because of all these externalities and disparities in information that were revealed, economists have concluded that the financial markets are definitely not efficient, and the financial crisis could be classified as a market failure.